Hi everyone, welcome back. I'm Philip Garrett, financial advisor with Carmichael Hill, and today we'll be talking about the difference between ETFs and mutual funds. Let's get to it. ETFs and mutual funds are often confused because of their similarities, so I wanted to clear up any confusion that there might be between the two investment options. Starting with ETFs, ETFs stand for exchange-traded funds. They are a type of investment fund and exchange-traded product, meaning they're traded on a stock exchange and they tend to be designed to track a specific index or sector. They're essentially a bundle of varying assets which can be bought and sold on the market. ETFs tend to be low-cost, tax-efficient investments, and they are often utilized as passive investments, although not always, meaning they're not actively managed by an investment manager that's in the background constantly monitoring and making decisions within the fund. This generally allows them to be offered at a lower cost due to the fact that there's not an investment professional that needs to be compensated. ETFs aim to mitigate your investment risk and exposure by helping to diversify your portfolio as opposed to constructing a heavily concentrated portfolio in one or a few individual holdings. This can be a great way to make sure your eggs aren't all in one basket. Now, mutual funds operate in a similar fashion as there are also pools of assets that can be bought and sold as a bundle. Mutual funds come in both active and passive varieties, but many are actively managed by a fund manager. One major difference between ETFs and mutual funds is how they're traded. Now, ETFs are exchange traded and can be bought or sold intraday at different prices. Mutual fund trades are executed once a day at a single price. Now, mutual funds are often not seen as tax efficient investments, especially not when compared to exchange traded funds, due to something called capital gains distributions. Capital gains distributions are essentially payments by a mutual fund or ETF of a portion of proceeds from the sales of the stocks or other investments within the bundle of pooled assets. As noted before, because mutual funds tend to be actively managed investment vehicles, there's a greater chance for capital gains to be generated and distributed to shareholders. When that happens, investors may have to pay additional taxes either at ordinary income or long-term capital gains rates depending on length of time the investment was held. So to summarize a bit of what we went over, ETFs and mutual funds are both market baskets of investments that tend to mirror indexes and aim to increase diversity by mitigating risk. ETFs tend to have lower operating expense ratios than actively managed mutual funds and are considered to be more tax efficient as well. And both mutual funds and ETFs may be great additions to your investment portfolio depending on your unique situation. As always, if you have any questions about what we went over today, please don't hesitate to give us a call. We hope you have a great rest of your day. Until next time.